Hi, everyone. Thank you so much for being here with us tonight. My name is Elena Hartley, and I'm the Vice Chair of USC Women in Economics. We are so proud and so excited to be welcoming an incredible guest speaker to join us here tonight. USC Women in Economics is a group of alumni from USC School of Economics who is proud to support students and provide great opportunities to showcase incredible women who are in the economic sphere. Speaking of, we have one with us tonight who's pretty amazing. Dominique Mielle joins us here for a fireside chat. She is an incredibly accomplished woman in finance, but also happens to be a recently published author. So Dominique recently published this book, Damsel in Distress, My Life in the Golden Age of Hedge Funds, which is a book all about her experience spending over 20 years as a really senior investor in the hedge fund world. Dominique, thank you so much for being here with us this evening.
Thank you so much for having me. It's a pleasure.
Well, I was hoping that maybe we could kick things off here with a quick intro on how the evening will go, and then we'll jump to you to share a little bit about how you came to be in the world of hedge funds to begin with. So just so everyone who's joining us tonight knows, you'll see, I believe the chat is disabled this evening, but you should be able to see a Q&A box down here with the two talk bubbles icon. Feel free to submit questions throughout the presentation. We want this to be as conversational as a webinar can be, and we're excited to answer your questions in real time. In terms of topics covered, we're going to be talking about everything from career advice all the way to Dominique's personal experiences and even her perspectives on the market and where things are headed in the future. So thank God she brought along her crystal ball tonight, and will tell us what to expect. So Dominique, without further ado, I'd love to maybe spend some time talking about how you first discovered finance as a career path and how you came across, I guess, hedge funds as your career path.
Sure. Well, it was fairly serendipitous, and I always start there because I think the usual image of a hedge fund manager and a person in finance in general is that of a man, usually a white man, who had a very early calling, who had a passion for finance and investing from a very early age, started trading and investing in college, or dropped out of college to start his own hedge fund. And that makes for a pretty intimidating sort of cliche. And it really was not my experience. I had no interest in finance. In college, I should say that I was born and raised in France, in Paris. And in college, I really had no interest in economics, in finance, and even less in accounting. What I did have a strong interest in is seeing the world. And so the first job I took was in New York, and it happened to be working for a bank, a French bank, in the credit analysis department. But really, I could have taken any job, marketing, basket weaving, you name it. It really didn't matter what it was. It mattered where it was. And after that, I got to know some people who worked in investment banking at Lehman Brothers. That sounded like an interesting job, certainly more intense than the one, and more lucrative than the one I had, which paid very little. So I spent 2 years at Lehman as a lowly analyst. Quite a miserable experience, I would say, in terms of the hours. So after that, I couldn't see myself continuing on that sort of pace, and I went to business school. And that's really where I found myself. I really realized that I did want to work in investing, that I wanted a job on the buy side, but it came sort of late in life. And I interviewed for this little company that had less than 10 people, around 500 million in assets, called Canyon Capital. And that was the one and only job I ever had. I stayed there for 20 years until I retired in 2018.
Well, you picked right. So I think that's great. And you used a couple of words here that I think are really interesting, and maybe we can quickly define them. When you talk about the buy side, can you kind of map out what that universe is and where hedge funds kind of fit in?
Sure. So I started in investment banking, which is really a large terms, but these are the Goldman Sachs, JP Morgan, the Lehman Brothers at the time, the Merrill Lynch at the time, and they do everything in the market from helping companies issue stocks and bonds, writing research, investing money for investors. So these are very, very large corporations. What we call buy side are the people who buy securities, who invest the money. What we call sell side are people who sell securities. So these would be the people on the banking side at Goldman, at JP Morgan, either writing about securities or helping companies issue securities. Hedge funds are, these are the sell side. Hedge funds are on the buy side, buying securities, investing the money on behalf of investors. Hedge funds are part of the larger industry called the asset management industry, which includes mutual funds, ETFs, many other disciplines, obviously private equity, venture capital. Hedge funds are a type of asset managers that are not or loosely regulated by the SEC. They have less constraints on what they can and do buy. They can be long and short. They can typically have more aggressive investing styles than other market participants.
Great. And so as you think about hedge funds in the broader kind of ecosystem here, a lot of students are often thinking about maybe they have an inkling that they're interested in finance, but they're not sure which direction to go. I guess from your experience getting started in your career in banking, what skills did that role help you develop? And what skills maybe did you pick up on the job once you entered hedge funds?
So I would say that the skills that you pick up along the way are the hard skills. Of course, if you are a student in economics or finance or accounting, it certainly helps to have this foundation. I didn't. I learned on the job being an investment banker. So looking and reading financials, building financial models, understanding how the stock and the bond market work, how a bond works, which is very different from a stock. I sort of learned over my 2.5 years as an analyst, but you could certainly learn that in college. I would say that some people, and particularly women, have this idea that it's incredibly technical as a job, that it's that it requires exceptional math skills. Look, it's not rocket science. I think all those skills can be learned. I think lots of skilled investors did not get a degree in finance. Certainly, some of the partners that at Canyon didn't have an MBA and didn't major in anything related to investment. We're in the women in economics space, so I encourage women to go to that field. But do not think that it's a requirement or that the hard skills are so difficult that it should discourage you from trying. And in terms of soft skills, to me, that's where it gets interesting because, again, I think the media image of an investor, and particularly a hedge fund manager, is this sort of hard-nosed, hard-ass, sleazy deal maker, kind of the Gordon Gekko of Wall Street. And to me, that wasn't that. To me, and my specialty, I should add, was trading distressed and restructuring situations. So very much fixed income, driven, and particularly companies that are having difficulties, either their business or their balance sheet. And so distressed was my specialty, and hence the title of the title of the book. But I would say I found that it required a lot of imagination, that it required creativity, ingenuity, all qualities that women have in abundance. These are not skills that you would say are either masculine or feminine. And I really think that that they're essential to being a good distressed investor. And of course, being resilient is important. Having a good sense of humor. You will, as an investor, lose money, even lose money a lot and often. And the job is to take it as the flip side of a winning trade and move on and continue. So that, that in a way, the job is an interesting lesson in life, because it shows failures as just business as usual.
And can you share an example kind of from your experience when maybe a trade didn't go the right way, and how did you handle it? What did you learn from it? How did you get comfortable with that kind of risk taking?
In general, first, I would say that risk taking it's sort of a muscle. Some people, or it's sort of, and I say that in the book, it's sort of like physical endurance. Some people have more than others, but you can certainly train and you can certainly learn and acquire more endurance to sort of build that little muscle. And really, that is what risk appetite is. The other sort of general comment I would make is that I think I know where you're going there, which is that there is some research, and there's certainly the image that women are in general more risk averse than men, and that may be true. But in investing, risk for the sake of risk is really not helpful. Risk is only interesting if it's commensurate with the return. And in that respect, women are often found better than men at adjusted a risk return bet. So, that's sort of the general construct, that risk appetite, risk tolerance, you can build it. Women might be less prone to taking risk, but they're also better at judging what risk they should take for the return. And that is really what you're looking for as an investor, and particularly as a hedge fund manager. You were asking for experiences in losing money. I mean, that happened all the time. One example I talk in the book is a very early and very large, for me at the time, loss in a company called WorldCom, which was a telecom company. This happened around 2001. You won't remember, but this was the time when there were a series of fraudulent companies, from Enron to Tyco to WorldCom, who that announced a very, very large accounting shenanigan, several billion, that led to its demise, its bankruptcy. And I had bought some bonds, which I thought I would get my money back. And in the flash of a second, there was a press release announcing that fraud, and announcing, a few days after the bankruptcy, and my bonds dropped from 96 cents to 20 cents. And look, it is god awful. I mean, you feel ashamed, you feel stupid. Let's just say it. It is searing. And I think you need to remind yourself that it happens to a lot of other people. I mean, of course, the first few times are just terrible. but the job is to really take it from there. So re-underwrite your investment. Now that your bonds are 20 cents, is it worth buying more? Should you get out of the situation? It's the idea of taking a fresh look. It really is no different from, having a failure. And be it because you were unlucky, or because the timing was wrong, or because you made a mistake, it'll happen. So really the crux of the issue is to just pick yourself up and show up the next day and just re-underwrite the steps and think about what the next move is. So sort of project what should be the right position from there, and it'll happen, and know that it'll happen again. I mean, in 2008, this was the year where everybody lost a lot of money, me included, and it is genuinely debilitating. You lose confidence, but you just have to look around and realize you're not the only one. And by the way, most of the people who have lost money are men, because they're they're only men in the industry anyways. So
I think the way the media portrays hedge funds, right, is kind of these big trades taking place and this glamorous lifestyle, and very Wolf of Wall Street kind of picture comes to mind. I guess, could you paint a picture of what the job was really like both at the junior levels and then as you progressed? How did the role change?
So picture the trading floor of a hedge fund, certainly Canyon, but many others that I know, as more like a library than the Hollywood image you would have of a trading floor. It's studious. It's usually fairly quiet. And people are either talking on the phone or reading financials or reading documents, bond indentures, and really trying to piece together a puzzle that gives you the right picture of a company, of its balance sheet and of its business, or the right idea about a restructuring plan. How do you get a company out of bankruptcy? How do you negotiate a plan, get all the parties to coalesce around a single plan that will be approved by everyone, including the bankruptcy judge, and then emerge from bankruptcy? But that's the atmosphere. The atmosphere is serious, committed to understanding an investment, a trade idea, trying to convince the partners of putting capital behind your ideas. So there's a selling aspect to the job. It's not just finding a great trade opportunity. This is not, an investment club, a fictitious investment club. You have people involved, and you gotta sell them on the idea. But it's a nerdy job, right? It's a highly intellectual job. It's a job where you make lots of decisions, but also, as I said again, where you get to look. My friends, my kids always ask me if I have any creative bone in me. So I said, well, I can't sing, I can't dance, but I can. I did feel like the job that I had was very creative in terms of finding solutions for companies that were in distress and needed a change, were in transition.
And in terms of I guess the foundation or the preparation that helped you tackle the job creatively and effectively. One question that we got from the audience here was around kind of college majors and how to think about what you study. And I know in your career, you've both been a junior person at a hedge fund and been the very senior person who is responsible for hiring a lot of the junior people. So you know what to look for. how important is what you studied in school, and how should people early in their careers be thinking about developing the right skills and honing that intellectual curiosity too?
I don't know if you can hone in that skill. I think you're curious or you're not. I'm not sure that's something that you practice. And again, the skills, the hard skills in college, I think it all can be learned on the job. When we were hiring junior people, of course, it helped if they had some banking experience, some private equity experience. If they had a degree in a related field. But again, I don't think that's essential. I don't think it's a must-have. And I think you can come to the field even late and still have a wonderful career.
That's great. And I think one other question that came through here is whether you have any thoughts on how to enter the buy side coming out of undergrad, or even coming out of maybe like a banking role or another sell side position. Any things that you saw work well for the junior folks, maybe that came over from your experience?
Run that by me again. Whether I had any thoughts
maybe tips or recommendations for students or people earlier in their careers thinking about how to enter the buy side, either right out of undergrad or coming out of a banking or other sell side program.
Look, if you have an opportunity to join the buy side right out of college, by all means, but it is difficult, particularly hedge funds. Although as hedge funds become larger and larger, they are now starting to have programs for undergrads, just like big banks have. I mean, hedge funds, the industry has changed so much in the 20 years that I was in it, from a very scrappy, secretive, entrepreneurial type of business to this institutionalized market participant that's known by everybody, and that where the players can be several billion large and really as structured and organized as a big bank. So they do have programs for college grads. If not, I think investment banking, for all its sorry hours, is a good training ground. It is certainly sort of a gauge of your ability to withstand pressure. So that's always a positive aspect. And other than that, I think you really, if you want to be on the buy side, it's just a matter of sending enough resumes and working your network. That is something that I don't know that women are that great at. Certainly I wasn't. And I would encourage, young folks in college to start networking. And I don't mean just having friends. I really do mean, if you're interested in hedge funds, you're listening right now, it's great to contact me through LinkedIn. But if you have a specific question, then do try to get a specific answer, as opposed to sort of a general business card that you put in a drawer.
Were there any, I guess, tools that you leveraged to get better at networking? How did you practice? How did you get out there and start forming more substantive relationships that helped you in business throughout your career?
As I said, I wasn't very good. I'm still not sure that I'm very good at it. I think you have to force yourself, and that's certainly not easy. I think it becomes easier when as you do it. So I really don't have any specific thing to say other than be conscious about making contacts, keeping contacts, and being okay asking for help. that's the most important thing. I mean, I did know lots of people, but I didn't necessarily feel comfortable asking for connections, and for help in general. And that is the very aim of a network.
Totally. Well, I want to make sure that we get to cover some of your really interesting perspectives and insights on the market too. So maybe switching gears just a little bit. I actually have your book right in front of me, and there was a sentence that made me so scared I could not sleep at night, because I'm also on the buy side. I was like, uh-oh. And it's right here at the opening of chapter 9. Dominique wrote, reflecting back on her time in 2008, saying that there were 2 ingredients of every financial crisis, plus a couple of others, that made it equivalent of a capital markets Molotov cocktail. And the 2 conditions, to paraphrase, that she found at virtually all asset price bubbles were leverage, which means too much debt in the market, and speculation, which is too much greed. And I think there's been a lot of talk recently around, are we in a bubble? What's going on? There's everything happening from inflation to labor shortages to just all the craziness that this past 24 months have brought. What are kind of your perspectives on the current market, and where do you see us going, if you had to guess?
I may be a dinosaur in the room, but it's hard not to believe that we're in something else than a bubble. I guess I'd say a few things. So the market in general, from pre-pandemic to today, has seen an enormous, I don't know what the S&P level is pre and post. I did that math many times, but it is significantly higher. And so you have to wonder, what did this episode of the pandemic add in value? Certainly some companies, Zoom, obviously, and some tech companies have generally improved their business prospects because of the pandemic. But the average company, I would think, has not. And certainly some of the companies that we've seen rise in market value, entertainment, the retail, it's hard to believe that a pandemic has added value to their business to the extent of the stock increase. So if it isn't that, then what else has pushed their stock higher? And the only answer to that is the Fed intervention and the liquidity that's been pushed into the system, rates being very low, and of course some help, in the form of direct checks to consumers, but mostly, rates being at bottom levels. So that, to me, is sort of the motor of this huge bullishness that we've seen since March 2020. And so, is it a bubble? I would think it is. Some of the companies that I know and worked on, AMC, Avis, Hertz, I did follow those companies, and I can tell you they're not worth 65 times EBITDA. They're just not. Now, I would caveat that by saying those may be the exception. There are meme stocks, there are strong stocks that are not reflective of the market in general. But these are bubble valuations. There's no question in my mind. What's also a very new phenomenon is the importance and the magnitude of retail traders. And that has added in.
Sorry, Dominique, can you pause and just explain what a retail trader is too?
I'm talking about non-professional investors, people trading on Robinhood, people trading on eToro, it's not a new thing. Day traders existed back in the dot-com bubble. We talked about them, but their sheer scale is now multiple times what they were in previous stages, and certainly they have they're a real powerhouse. They have the ability to move stocks. And so we're in this, to me, new frontier where stocks now are no longer the reflection of future discounted cash flows, but they also have a value related to the entertainment they bring. Meaning that if you're a holder of Tesla, if you're a holder of AMC, if you're a holder of Avis, you're part of this community, right? That's talked about in the media. You can cooperate, you can communicate, it's fun. You're sort of raging against the system. You can, I wouldn't say you can collude because that's a legal term, but it is almost like colluding, which, by the way, is illegal for any institutional investor. So in terms of a market force, it's huge, it's new, I think it's here to stay, and certainly it has a premium attached to it that old dogs are not used to seeing. Certainly I haven't seen them putting a value on it. So there are at least two major forces in the market. One is the Fed, obviously, and the other is this retail trade that keeps on marching and has probably never seen a market really go down and stay down. So these are super interesting. It makes the job I'm sure a lot more difficult as a hedge fund investor, but also really fascinating in terms of how do you value stock, how do you put together a portfolio, and by the way, this is not just for regular healthy companies. It also now has an impact on what was my specialty, stressed and distressed investing, because you're seeing all kinds of new scenarios and constructs for companies like Hertz that was in bankruptcy.
Well, Hertz is definitely in the headlines again as of late. I do think the retail traders are both kind of a cause or a driver and also an outcome of this bull market we're in, right? And one of the other interesting notes about this market is that my understanding from the outside in is that hedge funds have not fared very well during this time. It's been very hard for them to outperform a really strong market. And one question that we got from the audience here was, what do you think the trend will be for hedge funds specifically in the future? Has the golden age already passed compared to like the 90s and in the early 2000s? Where do you see that kind of asset class or type of manager going?
So hedge funds have had a hard time, and they've had a hard time for a while. I would say it's been, probably a solid 10 years where hedge funds have not been able to outperform the market. By that, I mean hedge funds as an asset class. Of course, some hedge funds have beaten the market sometimes, but really the deal with hedge funds is that you were paying enormous fees because they were going to consistently, systematically outperform the market. And that construct, that golden age is gone. I contend that it is mostly because of the size and the scale of hedge funds at this point. When hedge funds were small and nimble and able to react very quickly and time the market, it was much easier to outperform. At this point, it's tough to outperform the market when you are the market. And with some 15,000 hedge funds and close to 4 trillion in assets under management, it is an institutional investor or an institutional participant that, in my mind, is not going to outperform the market, at least, again, not as an asset class and not consistently. So does it have a place in the portfolios of investors? Of course, it does, as a agent of diversification, for sure. The question is, how much do you pay for that diversification? Or the fees should the fees be 1.5 and 20? It's doubtful. And how good is this diversification? Is it really a low correlation to the market? That's also a little bit questionable. So I think the golden age, if you think about an asset class that really beat the market consistently, I do think that era is over, at least for hedge funds as we understand them today. Will there be a better construct, a better fee structure, a new idea? Maybe. I hope you guys come up with that, better mousetrap. But otherwise, I think it's unlikely that we'll see them, have performances that we saw in the early 2000s or really up until 2008.
And we're talking here about hedge funds as an asset class. And by that, we mean all of the different firms that are operating kind of in this similar investing style or space, right? And I guess you mentioned here that there are some funds that are going to outperform, even if as an asset class, it's harder to maybe find alpha, right? Maybe some unique insights that they can invest around that will help them outperform the markets. For the firms that do outperform, are there any characteristics that you think will define those future hedge funds that come out on top? And are there any managers that you really admire or follow now that you get to kind of be on the sidelines a little bit?
I think the hedge funds that will come out better are the ones that will be able to look forward. And if I look at the universe of hedge funds, there are a lot that are still, they're sort of doing business like they did 20 years ago. So their investment team, and that's part of the theme of my book, their investment team is 10 white guys, just like it was 10 years ago. And it's run by the two founders who started the firm in, a lot of them started firms in the 90s. So by now they're in their late 60s, early 70s. To me, it's a little bit hard to think that with that same construct, you're going to be really equipped to look at the future, to think about, you name it, cryptocurrency in a constructive way, or the SPAC construct, or retail traders and what that new paradigm is. I mean, I think the funds that are at least equipped well will have or do have a diverse investment team, a very solid marketing team, but sort of a plurality of views so that the perspective is not one of groupthink, but one that really is, has multiple viewpoints, and where you can hear different voices, and there's a younger generation coming up.
And I think one point that you brought up that was interesting is this idea of crypto, which is definitely an emerging theme. I think it's on the top of a lot of people's minds. How do you think the emerging role of crypto is going to evolve? Crypto defined broadly, we got a question here around stable coins and the central bank digital currencies, but more broadly, how do you think about this as an asset? How do you think about the future of crypto?
So let me first say that I'm so far from being an expert. In fact, I would be closer to an ignoramus in the field. So please do not, I'll try to tell you what I think, but it is a very crass opinion. So with that disclaimer, I'm interested in crypto less. I think there are tons of crypto. It seems pretty likely that there'll be winners. Who are they? Are they, the Bitcoin and, the currency that we're seeing today? Is it a cryptocurrency that's blessed by central governments? I have no idea. And in addition to that, I'm not even really interested in the value of cryptocurrencies today. So the concept that Bitcoin is worth $68,000 or $68 to me is not very interesting. What is interesting is the ability to really get rid of the middleman and, in a lot of cases, of the entire banking industry, particularly on securities that trade. If I think of, most securities that we trade as smart contracts or digital contracts, the idea that maybe stock options, rate swaps, credit default swaps could be all those digital smart contracts that can be divided with any maturity, any strike, that could be bought and sold instantaneously without a broker, without an intermediary. That's just mind-blowing to me. The idea that loans made to companies that are, very sizable and come with hefty interest rates because maybe a company needs a 200 million loan quite quickly, and the only people able to lend that money are hedge funds, so they command a lucrative business because of their size. Suddenly that loan could be divided into tiny contracts and sold around the world, again, instantaneously, without brokering in microloans. That is just really an amazing opportunity. Can that be done? How difficult is it? That's another story, but it opens up just incredible opportunities.
Awesome. And one other question that I think is super interesting that came in here is, did you ever see other jobs along the way that may have tempted you or helped you think about what a different path could have been, either inside of a hedge fund or inside or outside of Wall Street, even more broadly?
Well, it depends on when you ask me. Before, when I was a college grad, I could see myself as a journalist that's, covering world news. Now, after I took a job in finance, but after I joined Canyon, look, it was a great adventure, and I loved it. There was nothing else I wanted to do for a very, very long time. I have to say, after maybe around 2016, 2017, as I saw maybe even earlier than that, as I saw the hedge fund industry evolving into those sort of mammoth fund, it seemed to me that the value of the hedge fund business sort of moved from the investment team to the marketing team. And the business of investing became more interesting to me than investing itself. What I mean by that is I became more interested in potentially creating new business lines. So I ran the CLO business for Canyon. I would have been interested in thinking about new products. So I think that it's a subtle difference, but it is a different nevertheless, sort of moving from the investment team itself to more of a strategic role. I think that would have been interesting.
I think that's a super interesting point, because a lot of times when people think hedge funds, they think investor, and there's a lot of other roles within an investment firm that makes everything tick. And marketing was an area that I only started to get exposed to at my own firm this year, and I found it super interesting. I never considered it as a career path previously. Could you talk about what marketing means in the context of an investment or asset management firm?
So marketing means a lot of things. It can mean the relationship with investors. It can mean the strategic direction of the hedge fund. So how they raise money, what they raise money for. And there are tons of business lines, like you would think of another, if you think of Coca-Cola or Nestle doing all kinds of products from chocolate to yogurt to soft drinks, a hedge fund or an asset manager has different products. It has maybe an investment grade bond fund. Maybe it has a private equity fund. Maybe it has a real estate fund. So marketing can be thinking about what product lines you launch, how you launch them, how you go to market, who do you approach to raise money. And it has a strategic importance in hedge funds that really is non-negligible. I would even argue, I have argued, that at this point, for large funds, I think really the value of the business is in marketing rather than in the investment team. Because think about it, we just sort of argued that hedge funds are not outperforming the market anymore. So why do investors invest with them? Why? Well, you invest with a Canyon and Apollo or KKR, not because they're going to outperform the market, but because they have a reputation, because their investor relations is excellent, because compliance is very good, because reporting is very good, because they're a one-stop shopping. You can allocate to different managers. So if you think of the hedge fund business as a mature business, what drives a mature business? The brand. It's less differentiated than, when you start. But what really provides value is the brand, the image, and that's marketing. So, and that's usually where you find the women. The interesting thing to me is that most of the compensation is still going to the investment team, not the marketing team. And I think that is not research driven, but my hunch is that that's also because the women are there. But it is yeah, for sure.
A couple of more questions coming in here, and I want to address them since we've only got 10 minutes left. This has been super valuable. Thank you so much, Dominique. One specifically, I think from a student here, it says, looking back, what is something that you wish that you knew when you first started in the finance industry? Maybe it was like an open secret, something you didn't know.
No, and I have a hard time with those questions because I am not one
to really think about what happened back 20 years ago. So I do have a very hard time. In general, I think if you knew something, it might have discouraged you from just entering and going step by step. I'm a person who just enters and tries it and always thinks, well, what's the worst that can happen? I can suck at it. Or somebody can tell me no, or and so what? Then I'll do something else. So I can't say that there's one thing that would have. First of all, how do you even go back and say, oh, if I had known that, this would have happened? I'm not really into scenario building for my own life. What I can tell you guys now is that network is important. I didn't do very much of that. Would that have made a change? I don't know. I think I had a fine career as it is, certainly a lucrative career, so it's all good. But I also want to carry the message that it is not this, we're not launching rockets, we're investing money, and that
it's not as technical and as intimidating that the media would like you to have, where either some hedge fund manager is a genius and always makes money, or he's a great failure and the fund closes. It's a job that's demanding. Lots of jobs are, but it's great fun. It's a thrill, really, to invest money. It's creative. There are fun people in it. There are not enough women and minorities and outsiders, but it is a profession that is worth considering. And it's, as I said, it's lucrative, which is usually not something women talk about, but that we really have to put out there. It is a job that can make you a lot of money.
And speaking of rocket science here, I think an area that can sometimes seem from the outside in to be rocket science are these concepts of quantitative investing, or maybe like algorithmic trading, that from the outside in seem really intimidating. What are your thoughts on quantitative investing? And do you think it'll be more popular in the future or less? Where do you think that's going?
I really don't know. I have no idea what the future of quantitative investing is. I think it's a legit asset class, but I have no particular insight or opinion on the matter.
That's great. We're taking the questions as they come, though, so that's awesome. Another question coming in here is, how do you look at short selling? What do you think the role of short selling is? And do you have any views about profitability, if it's healthy or destructive? What are your thoughts on that in the market?
Certainly, I don't think there's anything morally wrong about shorting. It's an investment strategy as another. It is, I have to say, great fun when you're right. When you make money on the short, somehow it's even more gratifying than making money on the long, because it's a lonely place to bet against others. So, in my career, when I made money on shorts, I remember it as being so fun, and you think you're just the man out there. That said, it's becoming incredibly dangerous. I mean, I just don't know that it's a viable strategy anymore, because again, if you think about it, retail traders might be sort of not sophisticated, educated investors taken individually, but as a group, they're a nuclear weapon. So, you're seeing that again and again. So I think it's, you have two things working against shorts in the equity field, the retail trade, and in the bond field, because it was a classic trade when I was an investor to short bonds. The problem is you've got the Fed against you. So that makes it, incredibly difficult as a strategy.
It's a great perspective. Looking at the time here, I know we've got 5 minutes left, and I have two more questions that I want to ask you, one from the audience and then one to kind of wrap us up. And I know we have a few more in the queue here, and as Dominique mentioned, it's a great way to network. It's if you have a specific topic you want a perspective on, so always feel free to follow up with one of us. First question here of the two. Someone from the audience asked, what are great literature or resources that you like to lean on to get a pulse of what's going on in the market? What is your information diet?
So I read the New York Times every day. I read Bloomberg. And then I read maybe every other day or so, I read the Wall Street Journal and the Financial Times. That's about it. I look at the stock market and read the news, read earnings release, but really between Bloomberg, the New York Times, and the Financial Times, these are my sort of daily. But then don't forget, I'm retired, so I can read all this over breakfast. I don't usually clip. When I was working, I'd get to the office around 6:30, and and that was the job, is to look through, hundreds of emails and parse through the information that matters and the stuff that doesn't.
And so when you say emails, I'm assuming that you all kind of subscribe to some big sources. I know a lot of like students and people early in their careers are also subscribing to like the Morning Brew and all kinds of Substacks and newsletters. And of course, there's Twitter and Reddit.
Then it gets more specific. What I also read, because I'm interested in distress, is petition. That's good. Reorg research is good as well. What else? Fundfire has good news about the asset management industry. I mean, it's endless. It's endless. It's too much.
I think that's a good lesson, that you can never consume all of it, right? And so you got to pick your sources. And then one tip I'll share from when I was a student that I loved it as my hack was, if there were paywalled or kind of pay-gated information sources, I would just reach out to the editor and say I was a student and ask if they'd be open to giving me an account for free while I was a student with my student account. So don't be afraid to ask, because if you don't ask, you don't get.
For sure. And that goes for information, that goes for your salary, that goes for your promotion.
Totally. One last question to wrap us up here. Dominique, if you had to give one piece of advice, one takeaway that you would want people to walk away from this hour with you thinking, what would you want people to take away from this conversation?
I would want them to think that hedge funds are now at a, if you think of every industry as going through an S curve of growth, that we're on the flat curve, and that we need, or they need, sort of a new engine, a new firepower to get to the next level. And that one of the tools, one of those, ignition engine can be a more diverse investment team.
Awesome. Well, thank you so much for sharing all of your expertise and experience with us tonight, Dominique. This was super helpful. And thanks to everyone who carved out the time to join us. Hopefully you got some valuable.
One more thing, if you'll allow me, which
is, of course.
There's an event next week for people who are local at ESMOA, which is a museum in El Segundo where I'll speak. So anyone wanting to meet and actually shake hands or have a book signed is welcome to come. It's on November 18. I would have loved to come to USC physically, but this was great fun, and I'm sure more convenient for lots of people anyways.
It's okay. Next chat we'll do on campus. But thank you again. And to everyone who dialed in here tonight, thank you. And keep an eye on your email, because we'll follow up with some information and a link to the event that Dominique is referencing for next week too. Thank you and have a great evening.